Today, let the Fed taper begin, but slowly. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. In today's show, we look at the dovish comments from the Fed, who is still preaching that inflation is temporary and the target is full employment. The US Federal Open Market Committee on Wednesday detailed plans to begin scaling back asset purchases later this month and said the bar to begin the lift-off in rates will be more stringent, so they're pushing it quite a long way out. But as the US Central Bank announced it was tucking away one of its main pandemic-fighting tools by trimming its massive bond-buying program beginning this month, its latest policy statement and Fed Chair Jerome Powell's remarks in a news conference signalled it would stay patient and wait for more jobs growth before raising interest rates.
Today, the FOMC kept interest rates near zero, and in light of the progress the economy has made toward our goals, decided to begin reducing the pace of asset purchases. With these actions, monetary policy will continue to provide strong support to the economic recovery.
Supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors, the Fed said in its latest policy statement, adding that an easing of supply constraints is expected to support continued gains in economic activity and employment, as well as reductions in inflation. So the monthly bond purchases of $120 billion, of which $80 billion is in treasuries and $40 billion in mortgage-backed securities, will be trimmed by just a mere $15 billion a month. Under the taper plans, the Fed will reduce monthly treasury purchases by $10 billion and mortgage-backed securities by $5 billion, but that means that the Fed's balance sheet will still continue to expand, but just at a reduced pace. The Fed instructed its market agents at the New York Fed to begin executing the reduced bond purchases in the middle of this month, but only laid out their plan for November and December. And that means that they will buy $70 billion of treasuries and $35 billion of mortgage-backed securities per month, a pace that will drop to $60 billion of treasuries and $30 billion of mortgage-backed securities in mid-December. So a very weak taper indeed. Now that taper would put the Fed on track to end its bond buying program by the middle of 2022, but the Fed did caution that the pace of bond buying may change depending on incoming economic data. The committee judges that similar reductions in the pace of net asset purchases will likely be appropriate each month, but it is prepared to adjust the pace of purchases if warranted by changes in the economic outlook. And at the conclusion of its two-day policy meeting on Wednesday, the Fed kept the benchmark rate in the range of 0% to 0.25%. Now, it's worth remembering that inflation has been running at a 30-year high, pushed by clogged supply chains, high consumer demand, and rising wages that have stemmed from a chronic labour shortage. Fed officials maintain that inflation eventually will drift back towards their 2% target, but now they say that could take longer. In the wake of surging inflation, market participants have ramped up bets against central banks' current views of the path of interest rate hikes. Traders are in fact pricing in 2 rate hikes in 2022. That's well ahead of the Fed's current projection for a single rate hike by late 2022 or early 2023. In fact, he fielded several questions about elevated prices but declined to offer a more hawkish assessment of the risks, beyond noting the high level of uncertainty and the commitment of the central bankers to their goal for 2% inflation over the long term. But Fed Chair Jerome Powell reiterated on Wednesday that the conditions for a lift-off in rates would be more stringent and would require further improvements in the labour market. We don't think it's a good time to raise interest rates because we want to see the labour market heal further, he said. We have very good reasons to think that that will happen as the Delta variant declines. Ideally, we would see further developments of the labour market in a context where there isn't another COVID spike, and then we would be able to see a lot, to see how the Labour participation reacts in the post-COVID world, he told reporters. We are going to have to see some time post-COVID, or post-Delta anyway, to see what is possible, he said, in reference to the coronavirus variant that is largely responsible for the COVID-19 surge and economic slowdown over the past 3 months. We don't think it's time yet to raise interest rates. There is still ground to cover to reach maximum employment, adding that he thought that goal could perhaps be met late next year. Although inflation was uncomfortably high, Powell acknowledged blaming it on turmoil in global supply chains that is likely to last until perhaps the second half of next year, and posing a challenge in the meantime to families on fixed incomes or those earning lower wages. Inflation for the last 5 months has been running at twice the Fed's 2% target and moving in a way Powell said could well satisfy the central bank's benchmark for a rate increase once maximum employment is reached. Our decision today to begin our tapering of asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate, he added. And in support of Powell's more measured outlook on rate hikes, the Fed chief suggested that factors including supply chain shortages that have driven up inflation pressures will likely ease in the second and third quarter next year. Now, the Fed's really thrown its weight back behind the drive for full US job recovery, restating its belief that current high inflation is expected to be transitory and, despite risks to that view, arguing that price pressures will ease and pave the way back for stronger employment and economic growth in the months to come. The central bank's message of ongoing accommodative policy did help to push the S&P index and the Nasdaq Composite to record closing highs, and Treasury yields ended the day higher, but the move was more pronounced on longer-dated maturities that are more sensitive to inflation expectations. The yield on the Treasury benchmark 10-year note ended the session back above 1.6% for the first time in a week, while the yield on the 2-year Treasury note, that's a proxy for Fed interest rate expectations, ticked fractionally higher to about 0.46%. Indeed, investors in recent weeks had focused less on the bond buying taper and more on the Fed's reaction to a surge in prices that promises to last much longer than anticipated than when it first took root in the northern spring. Powell's response was to acknowledge the uncertainty, but argued again that this was part of the reason why the Fed should not rush into a rate hike when it was still possible inflation would ease on its own and allow workers more time to navigate into jobs. They're hedging their bets, but that's not anything new, because we've heard publicly that they're a little less confident that things are going to come down as quickly on the inflation side as they thought, said Joseph Lavogna, America's chief economist at Natixis in New York. Along with supply chain disruptions, things just drag on a bit longer, and the statement reflects those realities, he said. The major averages jumped to fresh record highs on Wednesday as the Federal Reserve announced its plan to taper its monthly bond purchases later in the month, but stopped short of signalling sooner rate hikes. The S&P 500 rose 0.29% to a record of 4,660. The Dow Jones Industrial Average was up 0.29% to a record of 36,157. The Nasdaq climbed 1.04% to a record of 15,811. And the Russell 2000 rose 1.8% to a record of 2,404. Growth sectors of the market, including tech, which are sensitive to rate hikes, were sharply higher. Big tech included Apple, Amazon, and Google Alphabet were all higher. And following the decision, Treasury yields briefly moved higher, but the United States 10-year yield ended below 1.6%. Consumer discretionary stocks were also in the ascendancy following data showing signs of increased services sector growth. On the economic front, US service activity swelled to a record last month, driven by a further reopening of the service sector. The ISM non-manufacturing index, which tends to track the rate of growth of core retail sales, was overall very strong, rising to a record high of 66.7 from 61.9. That's well above the consensus 62. The surge in the market index sends a positive signal about the post-Delta economy, Pantheon Macroeconomics said in the note. The bad news is that the supply chain indicators, supply delivery times, prices paid, and the order backlog are all materially worse, with all three hitting new highs. And Powell said, I don't think we're behind the curve. Inflation's elevated, largely reflecting factors that are expected to be transitory. Supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. And the Fed unveiled its QE taper today as widely expected, but is still insisting that the surge in inflation is largely transitory, which suggests the doves still have the upper hand, wrote Paul Ashworth, chief US economist at Capital Economics. So Federal Reserve Chair Jerome Powell is still asking everyone to be patient on raising interest rates, despite announcing their bond purchases, but doesn't really argue that anything is yet to be concerned about with regard to inflation. I would describe it as a dovish tapering, said Carl Tannenbaum, chief economist at Northern Trust. He did not sound like someone who is nervous about raising interest rates sooner rather than later. Policymakers appear to want to preserve the option to hike as soon as taper ends if inflation is elevated. However, compilating the taper is a necessary but insufficient condition for the rate liftoff. And investors, in fact, had widely expected the announcement on asset purchases at the meeting, as Fed officials, including Powell, had signalled a move ahead of time. Powell's term expires in February, and he declined to comment on the nomination process. But President Joe Biden said on Tuesday he would announce his choice for chair and other openings fairly quickly. The renomination process has been complicated by an ethics scandal over unusual trading activity by some officials last year. Two regional Fed presidents stepped down following the revelations. Powell said he has briefed the Biden administration and lawmakers on the matter, as well as on steps the central bank has taken to tighten up the rules. The pace of taper clears the way for a possible interest rate increase in the second half of 2022, with 9 of the 18 officials forecasting a move next year in their September outlook. And Wednesday's statement reiterated that rates will be held near zero until the economy achieves maximum employment. Investors, though, continue to see 2 quarter-point hikes in 2022, starting around the middle of the year, according to pricing in interest rate futures markets. And several measures of the labour market remain weaker than pre-pandemic levels, and policymakers are likely to intensify the debate over whether the period before COVID-19 hit offers the best benchmark for a workplace that has undergone tremendous change in the last 2 years. I don't think we're behind the curve. I feel policy is well positioned to address plausible outcomes, Powell said. Traders largely maintained bets on the timing of interest rate increases from the level they were prior to Wednesday's decision. They were undeterred by Powell's reiteration of a previous message that there's no mechanical link between asset purchase tapering and a higher Fed funds rate. But there was also little cause for them to amp up pricing of rate hikes. Money market derivatives show about 55 basis points of rate increases by the end of 2022, little change from what was held at the start of the day, and the first hike is seen coming around July, with about a 70% chance of it coming the month before, according to the overnight index swaps. In short, we have a dovish taper underway, not a hawkish one, said Michael Dana, market strategist at MKM Partners. And the gap between the 2 and the 10-year yields widened about 4 basis points to around 113 basis points. The focus of this meeting is on tapering asset purchases, not on rising rates, Powell said in comments to reporters. We don't think it's time yet to raise interest rates. We think we can be patient, but if a response is called for, we won't hesitate. But the bank's Open Market Committee did reserve the right to alter the pace of asset purchases in its statement on Wednesday, but many expected it was most likely that the pace would persist until purchases are completed around the middle of next year. In practice, we believe it will take a significant shift in either economic or financial conditions to alter the pace of the taper, Michael Schall, Chief Executive Officer at Market Field Asset Management, said in the note. So in a way, the Fed is on autopilot now, tightly monitoring the situation perhaps, but hardly doing anything other than a little bit of tapering. And remember that the Fed's balance sheet will continue to grow over the next period. So this is very, very gentle action. And whether inflation will be as temporary as the Fed, and by the way, most other central banks, including the ECB, who reiterated again that it was temporary, and of course in Australia too, whether that is proved to be accurate, only time will tell. We need to watch specifically for wages growth, because if wages growth gets embedded, that will then translate to sticky inflation. And if sticky inflation comes through, central banks will have to act a lot further and a lot earlier than they would want, because they all know that even small interest rate rises from this point would rock the consumer boat, both in confidence terms, but also just in pure affordability terms, with the very high level of mortgages that people hold. This is one to watch. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.